Now, having a gold ETF is better than having no gold exposure or silver exposure. Problem is, it's still a stock. If you have an ETF, then you diversify. Oil, gold, the S&P 500, and consumable. They're all stocks. So if the stock market goes down, you're not diversified at all.
Hello, and welcome to the Alternative Edge Report. I'm your host, Olivia Voz, and today we're going to dive deep into the precious metals market with our special guest, David Morgan. David, welcome.
Olivia, it's nice to be with you. Thank you.
Well, I wish you were joining us in the warm weather, but David is coming at us from a cooler part of the West Coast. We're going to get into some hot topics today, though, for our viewers, starting, David, with diversification. A lot of people think they're diversifying their portfolios with gold and silver in terms of using ETFs. Is that the same as owning physical, though? Is it better, worse? What's your take?
Oh, I was going to say not even close, but I don't think that's accurate. But let's just talk about portfolio analysis for a moment. First of all, one of the best studies done on it was done by Ibbotson and Associates about 20 years ago. And they looked at what would the weighting be for the least risk, highest reward portfolio. And they found under all conditions, inflation, deflation, stagflation, 15% to gold, not a gold ETF. Another study was done by CPM Group, which is a metals house in New York. They do studies on all the metals, copper, tin, lead, zinc, gold, silver, platinum, palladium. They did a study from 1968, so it's more recent, till current day, and found a 25% weighting was the correct amount. Exactly saying the same thing, gold, not gold ETFs. Now, having a gold ETF is better than having no gold exposure or silver exposure. The problem is it's still a stock. And so if you have an ETF, then you're diversified. And it's oil, it's gold, it's the S&P 500, and consumables. They're all stocks. So if the stock market goes down, you're not diversified at all, because if the stock market crashes because of an event, that could happen even though you've got gold exposure. It might rise if the stock market was open, but if it was closed, it's still stock. So the real diversification comes from the real metal first. If you've got the exposure of real metal first, Olivia, you want to go into an ETF to gain some leverage or have a trading platform or a lower tax rate or any of those considerations. I'm all for that. I think that's fine. But I think if you really want to have diversification, you need to be outside of the stock.
It seems like the more I do these interviews, the more I learn the importance of owning bullion, especially like you said, if the stock market crashes, so can the ETFs. Speaking of that, gold and silver has had an insane run. They surpassed level after level, breakthrough after breakthrough in 2025. But so far in 2026, we're seeing a lot of profit taking. Is it possible that we can retake the highs again, or we're just going to kind of chop around?
Well, both, and I'll explain. First of all, we are in my studied view, the final phase of a major secular bull market. And it started really at 252 gold back in 2000. So we're in like year 26. Now, in that time frame, we had 11 years from 2000 to 2011 where gold year over year went up every single year. You couldn't miss. Silver went up almost every single year, and it actually outperformed gold. Then we had that high, and we went basically sideways to down for a very long time. And of course, we've regained a lot of momentum in the last couple of years or so. This is where we get the acceleration phase. I've said often on interviews that 90% of the move comes in the last 10% of the time. We are there. So we saw last year, Olivia, as you said, phenomenal move. Silver moved 140% in 1 year. And gold moved, I think it was 65% or thereabouts. Furthermore, January, we saw silver move 70% in 1 month. That is insane. I mean, that is like a double parabolic move. It's really accelerating. And I was warning people, public and private, that beware. Things don't go that fast and sustain it. And obviously, and we had a big move down. We had what I call a waterfall decline, about a 30% down move on the 30th of January. And people were panicking, especially if they were leveraged. And it was a big shakeout. I want to add on to that because we are still in a bull market. We are going higher, and I will get to your question. But the function of a bull market is to shake off as many people that believe the bull market but gets shaken off. The bull market's really a good analogy. If you've ever been to a rodeo or watched one on TV, those guys are nuts in my mind, but they get on that bull. If they can ride it for 8 seconds, they've done a terrific thing. And that's the analogy for the bull market, that bull's going to shake you off. So something like that is going to take people that maybe wanted to get in or waiting for the pullback. Now they're scared. It dropped too fast or whatever. But where are we? We're in a very strong market. I think we will consolidate, meaning go sideways for a short time. I don't think much more than maybe 4 to 6 weeks, and then we'll start back up. We could start back up in a matter of no sideways action. In other words, since we bottomed around 65 a few trading sessions ago, we're already at 85, $20 more in a matter of a few trading sessions. So, Olivia, this is a very strong market. How strong? I'm going to be able to tell more as, in the next week or two. If we're back up in the low to high 90s, in let's say 10 trading sessions, there is no consolidation. There is no, trading range, which is what I think will happen again for a short time. But we're, I would say, far from the top, but we're not at the top. I've not seen the top yet. And you got the big daddy gold, which is really going to march on higher and higher because of what we call the debasement trade. And Wall Street has come on board now. I mean, some of the stalwarts that used to make fun of people like me being, metals heads are now recommending stuff like that 20% weighting to gold. And this is on, the main financial channels. So I think we've got a couple of years left, and I think we're going to see, very high prices in both of them.
I love that analogy, getting thrown off the bull in a bull market. I'm going to steal that. And I promise I'll give you credit most of the time I use that phrase. But you mentioned the debasement trade. How about getting bucked off the buck, right? Has that been a reason why we're seeing a strong rotation into precious metals?
I think it is. I mean, once you get new buyers, and we have new buyers from several vectors. One, we have the Shanghai Gold Exchange, the Shanghai Metals Exchange, and this has been on board for a few years, but they've really taken over the physical demand on silver particularly. So you've got that added demand in the real market or the physical market. On top of that, Wall Street's come on board and said, hey, you need to have gold allocated in your portfolio or you're going to miss the boat. So those two things are synergistic. And further debasement, this is something that I talked about 25 years ago when I started my website. Currencies are being debased. You need to hedge it. You don't have to put all your money in gold and silver. In fact, that is not recommended. But have a hedge, have some, and hope that, we continue on and straighten out our fiscal policies in the government and things march on majestically. Although they're not, at least you're hedged. So we're in a position now where at the final innings of the game, or it may be like in the 8th inning of a baseball game, where everybody wants to pile in and save the ship, so to speak. They want to be hedged just in case. Portfolio managers are basically forced. Why are they forced? Because they have to show their constituents that they are performing against the total market. And if gold was the best performer in the last couple of years and the S&P lagged relative to gold, which it has, they need to be on board. So they're going to buy it whether they want to or not because they have to show performance vis-a-vis their peers. So there's a lot of momentum. I think it's going to continue, Olivia. And I would say we're just getting started. As far as the big picture, we are probably in the 8th inning. As far as that last final innings, we're in a really interesting game where there's going to be a lot of hits, a lot of homers, and a lot of grand slams in the precious metal sector because everybody has lagged behind and didn't pay attention for the first 7.5.
A strong precious metals market could be associated as a fleet of safety, bracing for recessionary or geopolitical fears. Is that the case, or can it be rainbows and butterflies while gold and silver continue to go up? And maybe it's just a shift in money from the S&P 500 to here.
It's a little of both. I mean, at my age, I've learned through experience, things never get as bad as you imagine, and probably never as good as you imagine. It's somewhere in between. Yeah, it is kind of a gloom doom trade at times, and it can be. But remember, even during the Great Depression, which, if we have another quote unquote depression or recession, it will be different than the 30s. I mean, there's a lot more safety nets than existed in the 30s, and it could be trying, but it won't be nearly as bad as the 30s. So as far as the rainbows part, what I said years ago, and I haven't heard it repeated for a while, is technology gets all of the press. It's all about AI now, but was back, it was memory chips back 20 years ago. I mean, everything's technology, technology, technology. So I said, well, the best technology stock you can buy is silver. Why is that? And of course, because anything electrical or electronic requires silver to function. So, that's kind of like the miners selling picks and shovels in the 1849 gold rush. They're the ones that made most of the money because it was a sure thing. Whether you struck gold or not, you still needed to have picks and shovels. So if you sold those and Levi's pants, you made money. So that's sort of what silver is for the technology sector. And I'm not trying to be, but I really think that we will see some stress in the financial system. I've been forecasting that for years, but it doesn't mean the end. It means really a new beginning. And I think what we're going to have to do is go lower as far as our lifestyle. I think we're going to have to tread water for a while, but I think it isn't going to be very long. And then we're going to come out of it, perhaps with new energy sources, perhaps a hydrogen economy, adding to the economy we already have. Maybe some innovations that are sitting there waiting to be discovered, already discovered, that just haven't come into public view. And I think we're going to have a far better future than we see right now. But getting there, I think we're going to have to cross that moat and jump that hurdle. But I don't think it's going to be long in duration.
That is the light at the end of the tunnel, I guess, and a well-painted picture, David. Let's shift from currency to cryptocurrency. We've seen some selling there as well, right? Bitcoin shedding nearly 30,000 at the top of this new year. Do you see further downside here? I mean, how could it get any worse?
I do. I'm not a big fan. I like the blockchain methodology because it's a truth. Once it's there, it's immutable. Everybody can see it. There's transparency. That part I really like. Bitcoin, when it came out, and reading the white paper from a purported Satoshi Nakamoto, was very inspiring because being a libertarian-minded individual, I looked at, wow, what if we could, do payment system peer-to-peer without any interference from a central bank? And that was basically what was stated. Now it's become the exact opposite. In fact, Olivia, I wrote a paper back in 2014 for the public because people trust me, and I'm no angel, but I do my best. And they wanted to know my opinion. So I wrote a paper called My Two Bits About Bitcoin. And in that paper, which is fairly long, still out there on the web somewhere, I stated that, this is what I like, this is what I don't like. But let me give you a caveat. This is in the paper, not you, Olivia, but for the paper. If this really gains momentum, really gains traction, and really becomes popular, the money masters will take it over. They'll usurp it. And that's exactly what's happened. I mean, BlackRock is basically in charge of Bitcoin, and it's become the antithesis of what it was once. Once it was peer-to-peer payment system, it's not used as a payment system. It's too costly and too sluggish. It's track traced all the time. And it's really kind of the opposite of what it was. So I did a deep dive, and I looked at the other side of the coin, pun intended. So we had the positive side of Bitcoin, and I looked at the negative side of Bitcoin. And I did a series of podcasts that are on my website for free. If you go to the blog, you go to the search engine part of the blog. So you're now on the blog page, search engine, type in crypto conspiracy. I did 30 podcasts on Bitcoin. And the basic premise of it was a lot of money that would have gone into the safe haven of gold and silver got diverted into Bitcoin. And certainly it was a stellar winner for a lot of people. But the ultimate problem is this: it's mined. And there's nothing wrong with mining. I'm pro mining. The problem is this: you've got to make a profit when you mine something, be it cobalt, be it silver, be it copper. When you're mining Bitcoin, the two largest, Riot and Marathon, are mining Bitcoin at roughly 100,000 coin. And we're now at, what, 66,000 or so. So they're losing money on every Bitcoin. The other problem is financing. They cannot get bank financing because the depreciation schedule of their miners, their boxes, their computers, these things in the data center sucking all this energy, the guess numbers, burn out after about 2.5 or 3. So no bank will give you a loan on a depreciation schedule of 3 years. If you're a miner and you got a piece of equipment like a giant truck and it's like a 20-year life, yeah, you can depreciate that and get a loan on that. So they're in dire straits. I mean, if you look at the financials of the miners and if they're losing money, and how do they stay in business? Well, they're diluting their shareholders. They keep issuing more shares. So take a look at the share price of Riot and Marathon and take a look at their financials and ask yourself, do I want to be invested in something that cannot be manufactured at a profit? The answer is probably not.
Yes, there has been a lot of debate about the framework of these companies. It's very concerning when put like that. But it seems like the bright future ahead of our main events, precious metals, 4 to 6 weeks, and we'll start to see some action again there. Do you have any advice for our viewers on how to advance their portfolios from here?
Olivia, thanks for asking. Yeah, I think so. I mean, I don't think you need to get, oh, I missed the boat and, all that. I think, first of all, as I said, 90% of the move comes less 10% of the time. And, I don't like to give numbers. I have and I will. I think gold probably will make it to 10,000, maybe more, maybe not. But I do think I think 10,000 is reasonably achievable in the next year or two. So that's a doubling of your money. Now, do you think the 50,000 Dow is going to go to 100,000 in that time frame? I doubt it. So I think you should have some, but again, you don't want to overload. I think a reasonable approach is to rebalance your portfolio. I mean, maybe if you're sitting and been an index investor and invested in the S&P 500, which by doing that, you beat most money managers. So let's say you were that smart. I'll look at it and say, you know what? I want to diversify into the metals. I'm going to sell, 10% of my S&P and move that into an ETF if you want. As we talked earlier, I would prefer you go into the physical metal and maybe add the ETF on top of it if you want, and look at it that way, because you really don't want to be in an anxiety. I mean, investing is really supposed to be something that's not only fun, rewarding, but you want it to lower your anxiety. I'm invested, and then you are more relaxed because you have your money working for you. And it's doing, stuff that you may need later on in life, or maybe take a vacation or whatever the prerogative is for having those savings and then investment or investments. So I think it's a holistic view. It's part of a portfolio. It's not something that you should really get much anxiety about. But on the other hand, I think especially now with the debasement trade, as you pointed out so well, if you're not invested in the metals, I think you should have a hard look.
A holistic approach to investing. Well put. Breathe in the passive income and breathe out the profits. David, thank you for sending us off with some good vibes. We will be delighted to have you on again. That's David Morgan, publisher of the Morgan Report. Again, I am Olivia Voz. This is the Alternative Edge Report. Make sure to like and subscribe so you don't miss future shows.